Welcome to the Financial Freedom Secrets Show. This is your host, Jackson Millan, the Wealth Mentor, helping business owners create financial freedom faster by mastering the language of money. Want to see how well you're tracking towards financial freedom? Complete our 40-point financial performance scorecard at wealthhealthcheck.com.au. That's wealthhealthcheck.com.au. The average score for most business owners is 18 out of 40. So complete the scorecard now and see how well you're tracking towards financial freedom. G'day guys, this is Jackson Millan, the Wealth Mentor, and I'm very excited to be back for another episode of the Financial Freedom Secrets Show. Over the last 5 episodes, we've been going through the Wealth Mastery Machine system, where we have utilized this system for over 1,000 clients to help them build in excess of $3 billion in combined wealth. This system works because it ultimately helps 7-figure plus business owners maximize their business profit and ultimately turn that into personal wealth so they can create financial freedom faster. Let me share my screen and run you through the frameworks that we've been going through. Okay, so if you want to get access to this playbook along with all of the other playbooks in this series, make sure that you go to wealthhealthcheck.com.au, complete the financial performance scorecard, and you'll get access to all of the previous recordings, all of the playbooks, and also all of our other best resources that'll help you implement lightning fast. So what we're talking about today is the Investment Operating System Playbook. Now, this is for 7-figure business owners who want to stop playing games with their financial future. Because here's the reality for most 7-figure business owners, and I've worked with thousands of them. This is what most business owners won't tell you. You're broke. You're not cash poor broke, but you're wealth poor broke. Like based on the amount of success and the money that you've made in your business so far, you should be so much further along. You've built a 7-figure business, but you're making money hand over fist. But you're trading time for dollars like some rookie entrepreneur who just read Rich Dad Poor Dad for the first time, okay? The idea is that the investment operating system fixes this. It's positioned as level 2 in the freedom pillar because most business owners never get past level 1. They're too busy growing the business to actually build real wealth. This is the wake-up call. Building real lasting wealth is boring. It's systematic. It's methodical. It doesn't give you a dopamine hit like closing a big deal does. And that's exactly why it works. So here's the promise. When you follow the system, you'll hit financial freedom in 10 years or less. Our fastest client actually did it in 5 years. And the reality check is most of you won't do the work, okay? You'll read this, you'll nod along, and then you'll go along just chasing the next shiny business opportunity. Don't be that person, because you're robbing from your future self. So what we've covered off so far in the Wealth Mastery Machine system is we went through the define piece, we went through the money mindset, the real roadmap, and the simple strategy to help you get crystal clear on your strategic plan. We've now started on the create piece. We went through sustained surplus of maximizing cash flow in your business and also maximizing cash flow in your household. Last episode, we went through the destroy debt piece where we showed you how to strategically use debt the right way and how to extinguish your bad debts lightning fast. And now we're talking about the investment operating system. This is about automating your investments so you can make money on autopilot. So let's talk about the foundations. Phase 1. The foundational work, you can't shortcut this, guys. Like here's the brutal truth around these prerequisites. You cannot skip this. I don't care how successful your business is. I don't care how much money you make. Without these foundations, your investment operating system will likely collapse like a house of cards. You must complete this list, every single item, and we've already covered this off in the previous episodes. So first is the financial infrastructure. You need to do this first. So you've got to go through your spender types. You've got to identify how you are wired to be able to know where your money goes. You need to set up the personal cash flow structure, separate business from personal. You need to go through the personal P&L so you can know your numbers. You need to review your expenses, negotiate and optimize. We need to cut the fat. We need to automate all of the transfers. So we establish that so you can remove yourself from the management equation. You need to set up your hub and spend cards and have them labeled. Simple systems work. Credit cards cancelled. Get rid of consumer debt. It's cancer to your wealth. Set up My Prosperity. We need a dashboard to get visibility. Make sure you do your annual roadmap. Make sure that you're clear on your goals. And then go through that debt destroyer plan because bad debt kills your wealth lightning fast. And then you need to go through your investment readiness. So go through your risk profile so you can understand what you can stomach when it comes to risk. Make sure you've got your cash flow war chest set up, like cash is king in a crisis. Make sure you've got an emergency fund defined because Murphy always shows up. That Murphy's law, right? And the risk management plan is in place. Make sure that you protect what you're aiming to build. And you've got your estate planning sorted because debt doesn't wait for perfection, okay? If you haven't checked every single box here, stop reading, go back and do the work, and then come back when you're serious. We've covered this in the previous episodes. Go and get that done first. All right, so let's talk about the 5 levers that actually matter. Most financial planning is academic garbage, okay? I argue with financial planners and accountants and so-called advisors on the internet all of the time. These people have absolutely no understanding of how to build real wealth, okay? Here are the 5 things that really move the needle. So 1 is your current position, okay? Where are you right now? You need to document everything. You need to know your assets, your liabilities, your income, your expenses. No guessing, no approximately, the exact numbers. This is your starting point, and you cannot improve what you don't measure, okay? Second is surplus. This is your wealth building fuel. This is actually the only lever that you can truly control. Calculate your monthly surplus in the business and also your personal household. And then work out how do you plan a profit allocation increase over certain business milestones that you achieve. Because if you don't have surplus, you don't have a business, you have an expensive job, and you certainly aren't going to be able to build any wealth. Lever 3 is risk. How much can you handle? You need to complete a risk assessment and be honest. And we need to set a conservative growth rate expectation because most business owners think that they can handle more risk than they actually can. You're not different. The goal is to take the least amount of risk necessary in order to achieve the outcome that's important to you. Lever number 4 is time. This is the great equalizer. Set your financial freedom target age. Calculate the exact amount of years that we've got remaining to get there because we've got to realize that time is the only resource that you can't buy more of and you need to use it wisely. And of course, the shorter the time frame we have, the more surplus we're going to need and potentially the more risk that we're going to have to take in order to get to the outcome that you want. And then lever 5 is the financial freedom target, what you actually need. So define the required passive income in today's purchasing power. That allows us to calculate the total wealth target that we need, and that helps you stop guessing. We get the number, we plan to that number. We covered that off in the define section of the real roadmap and the simple strategy. So go back to that and we'll show you exactly how to map all of that out, okay? Now, what we now do is we get into phase 2, which is the system design, because ultimately our investment operating system is about getting us to the financial freedom target based on how all of those levers are working together. And this is where most people fail because there is a systematic way that we ask 7 questions that allow us to build wealth. Okay, we call this the investment operating system. So what we want to do is we want to implement a framework that separates pretenders from real wealth builders. And we need to answer every single one of these questions because it's always one of these 7 questions that we are focused on optimizing. And we need to review this monthly. So we're focusing on 1 to 3 of these core areas as the immediate priority. So question number 1 is always, what can I do to grow my income? So review business profit allocation milestones. Stop leaving money on the table and plan owners pay increases systematically. So for most of our clients, they're looking to increase their owners drawings on a quarterly basis. And we're working towards, we start with quarterly distributions of profit. And once they've got consistency building up in that profit account, we go to monthly distributions. We're always looking to grow income because it's significantly easier to grow income than it is to cut expenses. Now, question 2 is expense control. How do I control my expenses? This is important. Control, not cut, because ultimately we don't want to compromise your lifestyle and the sustainability of your strategy. This is not about shrinking yourself wealthy. We want to make sure that we're controlling the expenses so we don't have the cash flow creep as our income increases. So, quarterly expense audits, no exceptions. Negotiate everything if you possibly can. Every contract, every subscription, everything's negotiable. Interestingly enough, we made a review on our debt portfolio in the business recently, and we were able to negotiate a 2% rate reduction as a result of 1 phone call and 1 email. Really, really simple. Lifestyle inflation kills more wealth than any market crashes. So ultimately, we need to make sure we're growing income and controlling expenses because that's going to allow us to amplify our surplus. Number 3 is financial security. What do I need available to give me peace of mind? So let's consider the emergency fund. Most people, it's 3 to 6 months of expenses minimum. We want to make sure we've got that cash flow war chest for opportunities because it's those who have the cash ready that are able to jump on opportunities. A client of mine recently, we've been able to build a substantial war chest in their bucket company, millions of dollars of cash. And we saw a recent opportunity in the share market that we're able to jump on stocks that we knew that were of fantastic value, and we're able to get them on discount because we had cash available. We were essentially buying stocks that were at the price they were 12, 18 months ago because we had the cash. And of course, the important thing here is the liquidity buffer for the unexpected. Okay, really, really important. Now, question 4 is lifestyle goals. What are my lifestyle goals? We need to be specific. Vague goals produce vague results. Calculate the cost of those lifestyle goals in today's dollars. So if you want to renovate your home or upgrade your home, if you want to go on a holiday, if you want to send the kids to a nice school, all of these things are going to have cash flow requirements, and we want to ensure that we've got the money set aside for these things. And make sure that you plan the timing for these major expenses, because the last thing we want to do is to put money into long-term assets and then be forced to crystallize and sell those in the short term prematurely in order to fund those lifestyle goals. This is the idea of having our cake and eating it too. We want to be able to do both. Question 5 is future options. So what financial options do I want in the future? So it's that retirement lifestyle. What's the financial freedom figure? Is there business exit scenarios? Is there family wealth transfer goals? What this allows us to do is to work out the timing and the financial requirement of these future financial goals. So then we can work out how much wealth we need to build and in what buckets. So now we get to the 3-bucket allocation strategy. So we stop overthinking and we focus on just pragmatic asset allocation using 3 buckets. So bucket 1 is our short term. This is 0 to 12 months. This is immediate goals, holidays, emergency expenses. We usually have this in high liquidity savings accounts or in offset accounts. It's boring, it's safe, and it's available when we need it. Bucket 2 is income assets. This is cash flow generation. So this is high dividend stocks. This is commercial real estate. These are cash flow businesses. The goal is to work towards replacing your salary with passive income. But we also want to be mindful that we're not focusing on creating passive income too early. We'll talk about this separately. Bucket 3 is the growth assets. This is our long-term wealth. So we want to focus on capital appreciation. We ideally want tax-deferred growth until sale, and we ideally don't want to touch this until financial freedom. So this is high-growth stocks, this is residential real estate, these are the types of assets that we're acquiring. Now, we get to our next question, which is question 6. How will I use leverage to accelerate my results? So, assess actual borrowing capacity, not bank estimates. Define the maximum loan-to-value ratios. Plan debt serviceability for worst-case scenarios. And we've got to realize that leverage amplifies results, both good and bad. Okay. So this is what we covered off in the last podcast and the last playbook. Go back to that. We've got a complete guide end to end of how you can build that strategy. Now we've got return expectations. Question 7. What are my return expectations? So we want to set conservative baseline assumptions. We want to under-promise, over-deliver, okay? And we want to account for inflation, because we've got to realize that inflation is eroding our buying power each and every single year, so we want to be mindful. Progress tracking. Question number 8. Does my net wealth have me on track? So once we've answered all of these questions, we want to be able to review our quarterly wealth management. So this is our money milestones. We want to look at our actual versus our projections and ask the question, like, why aren't I matching the projections, or why am I ahead? And it allows us to then have this feedback loop. And we want to make sure we adjust when reality doesn't match the projections. This is about that course correction to work out what are we going to do to keep on track for the plan. Pretty straightforward. So phase 3 is the implementation. This is where the success happens. So the automated investment strategy is so important for business owners because manual investing is for amateurs, okay? You're running a 7-figure business. You don't have time to play day trader, okay? You don't have time to manually manage all of this wealth because it ends up becoming another job that you're doing part-time with fractional bandwidth, and it's an afterthought. So how do we do this for our best clients? We do this with our clients who've come to us with $100 million of investment assets, okay? We set up a monthly automation. We have a systematic surplus allocation, same day every month. We use dollar cost averaging. We let the math work for you. As the market goes up and down, we're drip feeding money in. And we remove emotional decision making from the equation. Next, the investment selection framework. We have a structured criteria for every investment decision. We have an objective education framework, not on gut feelings. And we get professional advice for complex decisions. We always want to make sure we've got a sounding board. Even for my most sophisticated clients, they use us as a sounding board for any of these opportunities before they make the decision. There's no point doing it once you've already signed the paperwork. Know your limitations. So here's the asset allocation reality check. Here's what actually works for seven-figure business owners. And look, this varies from client to client, but this is typically what the vast majority of our clients do in terms of their asset allocation strategy. So during this accumulation phase, whilst they are building their wealth, they focus on 70% growth assets. So we're talking about residential real estate and we're talking about high growth stocks, and then income assets 30%. So this is cash, fixed interest, bonds, but also looking at other investments like commercial real estate investment trusts, dividend paying stocks. And then our cash reserves is based on our emergency fund only. How much cash do we need to have available to fund for the unforeseen and to capitalize on opportunities? Then, when we get to financial freedom phase, we're living off the investments, we have been shifting the portfolio. So we usually drop to about 50% in growth assets because we still need that compounding to snowball the wealth, right? We want to make sure we're maintaining our asset base. We have 40% in income producing assets, primarily higher income, so dividend paying stocks and commercial property, and then 10% in cash so we can maintain liquidity. And for some of our clients, that cash might be 1 to 3 years of their living expenses in cash, just in case there's a flash crash. We have the opportunity to not have to worry about crystallizing losses if the market does fall. So let's think about this. The 8% return reality. If you want 8% annualized returns, you need on average about 70% in growth and income assets, okay? And ultimately keeping that money in cash is a guaranteed way to go backwards after inflation. We see a lot of smart and sophisticated business owners keep too much money in cash, and it is being eroded every single year by inflation because they're just waiting for the perfect opportunity to get into the market. Doesn't make a lot of sense. So let's talk about the investment types that matter. Growth versus income tax reality. We've got to realize that chasing income too early is detrimental to your wealth. Income is taxed at marginal rates immediately when it is received. Capital gains are only taxed when they're sold, often at reduced rates. Ultra wealthy focus on growth assets, and in many cases they actually use debt for liquidity. They borrow against their assets because you don't pay tax on debt. You're not ultra wealthy yet, so we need to balance both, okay? So we've got to consider investment categories, direct equities versus investing in a mutual fund or a managed fund. Know the difference, right? A lot of our clients invest in index funds because they don't want to actively trade the market. Model portfolios versus pre-mixed solutions. Understand what you own. Like, do we want to have control over our portfolio strategy, or do we want to go and trust a professional fund manager to do that allocation for us? The difference between active and passive. So an active manager who is looking to outperform the market after fees and taxes versus an index fund that's completely passive, which is significantly cheaper and on average has outperformed about 80 to 85% of the time. And then superannuation. Don't sleep on super. Using tax-effective wealth building strategies, because there's no other strategy that you can have that by the time you turn 60, if we convert it to pension, pays zero tax on any returns and zero tax on any income that you draw. It can be a phenomenal strategy, but it's important to understand where that fits in with your overall strategy that you're trying to achieve. Now, phase number 4 is the monitoring. This is the discipline that builds fortune. So, monthly reviews. It takes 30 minutes. There's no excuses. Every month, same day, same time, we check the automated transfer execution. We review the portfolio allocation versus the targets. We monitor our cash flow requirements and we make adjustments if needed. Quarterly deep dives. We progress against the milestones. We need to be brutally honest. We do portfolio rebalancing when required. So if one asset is outperformed and it's gone out of the weighting, we make adjustments. And then financial projections are updated. So we use reality to update how we're tracking. And then we do an annual strategic overhaul. We complete the wealth health check. We review our risk profile. We review our asset allocation strategy. We review our estate planning. And then we go through our investment decision framework. So we stop making emotional decisions. We create investment evaluation criteria. So we define the financial metrics up front, because when we look at an investment, we don't want to look at it through rose-tinted glasses. It should be compared against key metrics that either pass or fail. We establish performance benchmarks. We create structured decision-making process, and then we implement emotional control strategies. Because as a business owner, you end up getting given more opportunities the more successful that you are. And some of them can be really exciting, but unless they align with the strategy, there is no point. And in many cases, we want to keep this as boring as possible. And to help with this, we want to make sure you've got the right professional support. So make sure that you're working with a great financial advisor on at least a quarterly basis. You're working through your tax planning coordination. We want to be proactive, not reactive. There's no point having this conversation after 30 June when the tax is already done and you can't implement any strategies to optimize. Estate planning updates whenever life changes, and obviously your investment network of professionals who can bring vetted and researched opportunities to the table that align with your philosophy for investing. Now, there are advanced strategies for serious wealth builders. So when we think about investment property, we do things like special purpose vehicles. We do this for tax efficiency. We do this for being able to access more debt. There are strategies that we do that allow us to optimize this for higher income individuals. But it's important to understand that there's obviously costs associated with this, and we make sure that we are wanting to update this depending on your current situation. And when we think about leverage optimization, we want to define our loan to value policies up front. We want to review our debt serviceability. We want to make sure that we manage our liquidity. And obviously, we want to understand our asset segmentation. So be mindful. Leverage amplifies everything, your gains and your losses. You want to use it wisely. You see a lot of gurus out there that have $50 million property portfolios, and many of those people have almost lost their shirt in the past. So it's very, very important to understand that you are magnifying your risk. So we want to make sure we've got the right liquidity. So let's talk through the quality assurance. Implementation validation. So make sure that you've gone through the foundations. Make sure it's 100% complete. Go through the investment operating system process to make sure it's documented and automated. Go through the risk profile matches against your allocation strategy. Get professional advice, okay? Make sure that you set up your monthly monitoring system and it's operational and it's being used. Set up your emergency fund and war chest fully funded. Get your estate planning done. And then for your performance tracking, make sure that you've got your monthly investment contributions automated. Set up your portfolio allocation within those target ranges. Make sure you've got some sort of net wealth tracking against your financial freedom goals. Make sure you've got your cash flow requirements met without having to sell assets, and then make sure that your return expectations are realistic and being achieved. So let's go through troubleshooting, when things can go wrong. So problem, common thing we see. I know what to do, but I can't execute. So the reality is the pain of your current situation isn't big enough yet. Most people need a crisis to motivate change. Don't wait for the crisis, okay? What we need to do is just break this down to as small and simple as possible. So we need to calculate the cost of delay. Like, what is the impact of you not making decisions today? Break the implementation down into 15-minute daily tasks. Get some accountability. Like, we help our clients implement this stuff, so we hold them accountable. And start with the easiest item on the list. It's not that hard to set up, guys, particularly when you've got help from a professional. Next, I want to outsmart the market. I see this all of the time. You just can't. Like, stop trying. Every business owner thinks that they are different. You are not. Let me give you an example here. If you go to the Spiver report, which is a report that's done every single year on the performance by region of active fund managers against the index. Let's look at Australia, for example. So over the course of the last 15 years, 85.3% of active fund managers have underperformed the index after fees and taxes. Okay, so it's 15%, less than 15% of the market have been able to outperform after fees and taxes. Let's look at the US, it's even worse. 88% of funds underperform the market. So only just shy of 12% have been able to outperform consistently. And the interesting thing is that in many cases, the fund that outperformed in one particular year is not the highest performing fund the next year. So if these are professional, educated, full-time fund managers and they can't even outperform the market, what makes you think that you have any chance to outperform the market? Even my own personal strategy for the share market is 100% index investing, okay? Keep it simple. The idea here is that every business owner thinks they're different, okay? So complicated schemes fail more often than they succeed. Risk usually outweighs the returns for these clever strategies. And the idea here is my mentor, who was a billion-dollar fund manager, gave me the best piece of advice. He said, Jackson, play with your partner, not your portfolio, okay? We stick to simple, systematic approaches. Next, when should I buy, sell, wait? You're asking the wrong questions. These are symptoms of not having an investment operating system. We need to be systematic. We buy and we invest systematically, irrespective of whatever the market is doing. So the questions we need to ask is, am I contributing consistently to my investment accounts every single month? Is my allocation within target ranges? Are my investments meeting my long-term return expectations? And do I have adequate liquidity for emergencies? These are the questions that you should be asking. Next, my investment properties are cash flow negative. Well, that's not necessarily a bad thing, particularly when you're in the accumulation phase. But ultimately, as you get closer to financial freedom, none of our clients hold residential real estate in significant amounts as investments in retirement because it's not great for cash flow. So you either need to significantly reduce your LVR. So we typically find most residential properties are cash flow positive or at least cash flow neutral at about a 60% loan to value ratio. Target higher yields, 7% minimum. Very hard to get in residential real estate. This is where people start moving towards commercial real estate. Add income through renovations and improvements. Once again, this is a more sophisticated strategy. It does require you to invest more capital, but it can be a worthwhile strategy. Many of our clients do a dual occupancy strategy of doing granny flats and things like that. It can work well. And integrate with other income producing assets in the structure. So the idea here is that if we can invest in, say, blue chip stocks that pay 6 or 7% dividends, it is going to provide us with the cash flow requirement to buffer against the negative cash flow of residential real estate. So let's go through the resources and next steps. The best thing that you can do is to go and complete the wealth health check. There are 30 things that you need to consider as a business owner across your wealth strategy, your profit strategy, and your tax strategy. The wealth health check will help you facilitate that and ultimately give you some insights around the lowest hanging fruit. Next, all of this tracking can be done automatically. We use a platform called My Prosperity. You do need to have an advisor in order to do that. So if you'd like help setting that up, feel free to reach out to us. And this automates all of the tracking. It gets data feeds from all of your bank accounts. It gets your properties linked. So that gets automated data feeds from RP Data. Your investment portfolios are linked. And it allows us to track against the plan active every single day. Make sure you've got a professional advisory team. Stop winging it by yourself. I know you're smart, but the idea here is you want to surround yourself with people who can hold you accountable to making the decisions. You need a tax advisor. You need a financial advisor. You need a solicitor. And then the calculation tools. If you want to crunch these numbers on Wealth Health Check, the bonus resources, you'll get access to all of those. So, implementation timeline. 1, do the foundations and the gap assessment. 2, complete all the foundational checklist items. Week 3, design the allocation strategy and set up the automation. Week 4, launch automated investment execution. Then month 2 is first monthly review and adjustments. Month 3, first quarterly deep dive review, and then ongoing. Schedule 30-minute reviews, your quarterly assessments, and your annual overhauls. If you've got a good financial advisor, they are going to get you into this review cadence as part of their process, okay? So, when you're looking at building a professional network, firstly, a financial advisor. You need somebody who's got experience working with 7-figure business owners because a lot of financial advisors are either going to flog you product or they're going to give you transactional personal advice without any consideration for your business, okay? This is not going to help you move forward. We specialize in helping 7-figure business owners. We look at their business and their personal finances and create a holistic financial plan. Fee-for-service model. You want to make sure that you are paying a fixed fee. They're not incentivized by the amount of wealth that you have or receiving commissions. Quarterly review commitments. There's a regular cadence. Catching up with a financial advisor once a year is not going to move the needle forwards. You need accountability to hold you on track and to make those course corrections. And obviously investment platform access, that they have access to a broad range of investments and they're not aligned with any particular provider that they're forcing certain products down your throat. Tax agent and tax advisor. You need somebody who's got business and investment tax expertise. They're there to provide you with proactive tax planning. They can review your tax structures and provide you with proactive advice. And they have regular communication to keep you on track for your tax plan. And then legal support, like your estate planning. Get somebody who's a specialist in estate planning, somebody who understands business structures. Obviously with property, you've got somebody who's a specialist in property conveyancing. And then obviously you're reviewing your legal documents on a regular basis. So, final warning. This playbook works. I've implemented this myself and I've utilized it to build over $15 million in net wealth at 36. We've helped our clients build $3 billion in combined wealth as a result of this system. It's based on a proven methodology that's helped clients achieve financial freedom in 5 to 10 years. But it only works if you work it. Now, most of you are going to read this, you're going to get excited, and then you're going to do nothing. And you're going to go back to building your business and ignore wealth building because you've still got time, right? You'll justify saying you're too busy or the timing isn't right. The timing will never be right. The best time to start was 10 years ago. The second best time is right now. Don't be the business owner who builds $1 million company but retires broke. We see it all the time. Like, here's what happens when you don't implement the system. The reality is you'll probably work until you die. Your business becomes a golden prison. Market volatility will terrify you because you don't have a system. You retire on whatever super you've accidentally accumulated, and your family will inherit a business that's probably worth nothing. They're not going to get real wealth. But here's what happens when you do implement the system. You work towards creating financial freedom in 10 years or less. Your business becomes optional, not mandatory. Market volatility becomes an opportunity, not a threat. You retire wealthy with multiple streams of income, and your family inherits a legacy of financial education and assets that work for them. The choice is yours. The implementation reality check. 80% of people will read this and do nothing. 15% will start but quit within 3 months. 4% will partially implement and get partial results. And 1% will follow the system completely and work towards achieving financial freedom. Which group will you be in? Start today, execute ruthlessly, and build real wealth. Your future self will thank you. Now, just remember, the investment operating system isn't just about making money. It's about creating freedom and making decisions without sacrifice or stress, knowing that you will always have enough. This is a fundamental shift in your mindset because that's what wealth really means. Now, stop reading, start doing. The clock is ticking. Every day that you delay is compound interest you will never get back. Make sure that you begin now. So jump onto wealthhealthcheck.com.au, grab a copy of this guide, get all of the other resources, complete your scorecard, and if you'd like some help implementing the investment operating system, feel free to reach out to us. Love to have a conversation. I look forward to catching up with you for the next episode of the podcast where we're going to get into the manage piece of the equation and start talking about how we magnify our money. Look forward to catching up with you guys soon.